All right, so folks, thanks so much for watching. And again, we're going to be focusing for a while on a theme that we're calling Winning the Wealth Game with Camarda. And as you may remember from the last podcast, we got a pretty interesting, I guess, wake-up call is a good way to describe it. Some information from a client that had been approached by another advisor and was kind of lured by some slick sales talk that turned out not to be entirely correct, and some really lowball pricing that wasn't the total picture. So we really got into it and kind of reminded them of what separates us from most other advisors. He found that extremely valuable, and we wanted to be able to share that lesson because a lot of folks come to us and because forgive us, we think we're really, really good and we care a lot about you. We bring a lot of value to the table, very sophisticated integrated planning that is often not available elsewhere, no matter how hard you look, which is why you came to us in the first place. But as time goes by, you tend to forget that. So I think it's important to remember, and please share with friends and family because they could benefit themselves, some of the differences that Camarda brings to the table. So we call the Camarda Difference really total wealth care, and we feel so strongly about it, we actually trademarked with the patent office the phrase called stay richer to live freer. And that really is our objective for you. One of the things that we really, really look to do for folks, and the folks that tend to resonate with us the most are like this. Number one, they demand exceptional, multidisciplinary wealth and tax expertise. Putting in are good in all the important wealth domains and putting it together so it's efficient and well quarterbacked. They expect extraordinary white glove service and responsiveness from our advisory team led by these guys, both certified financial planners and very, adept students of advanced wealth, sharpening the saw every day pretty much, with me and the rest of the team. Clients that appreciate transparency and they know what they pay and what they're getting. A lot of times with advisors, you just don't. You see this much of it. If you see anything at all, it's really expensive, often a lot more expensive, but it's, you're not shown, obviously it's not transparent because those advisors don't want you to see maybe you wouldn't work with them if you knew how much it costs. And they also demand absolute fiduciary loyalty. And let's kind of talk a little bit about that, Lou, and what does that mean to you? What's absolute fiduciary loyalty?
What it means to me, it means that you're putting clients' interest ahead of your own 100% of the time, all the time.
Yeah, and how about you, Anna? Would you like to expand on that?
So when we recommend something to a client, we're not worried about, am I making a commission? Are we making more money here or here? It doesn't matter because of the way that we structured the firm here. I know I can deliver advice and I'm not considering, again, any of those things. Am I going to make more money? It doesn't matter because we're fiduciaries and the client's first.
Yeah, so our business model is like a physician or an attorney or CPAs, most CPAs really. We deliver advice, objective advice that's laser focused on what's best for you without being influenced by other compensation considerations, which is pretty rare, as we'll get into, in later podcasts. And also, a lot of our clients, particularly now what's going on in the world, are as concerned with preserving their investments as they are with growing them, right, Lou? And
Absolutely.
You guys can probably speak directly to some client concerns. You want to maybe expand on that a little bit?
I mean, yeah, 100%. Especially in today's market environment where it's so unpredictable day to day that it could go up, it could go down. It's very news driven, I feel. Protecting what you have. Yeah, it's great to make a good return on it, but protecting that nest egg, protecting what you have is also as equally or maybe more important, more important than
especially at this inflection point now, as we talked about, in some of the current event segments lately. The world is changing very rapidly. The markets around the world are at bubble proportions. They may keep going up. Who knows how long? Sooner or later, probably will burst. And to work a lifetime and get really good returns and then see it drop like in 2000, 80%, that'll kill you. You're not going to recover from that if you're anywhere close to retirement. Would you care to elaborate on that?
Yeah, I think a lot of our clients are deep into their careers, approaching retirement, in retirement, and as you go through these phases of life, we have to take some risk off the table responsibly, right? And you don't have as much time to make up from a drop like that, where maybe in 2008 when you were a lot younger, or 2000, you could have experienced it and just gone with it. When you're drawing income or close to needing to draw income from your investments, we really have to be more concerned with preserving the principal than growth at that point in time.
Yeah, well said. And for that reason, we are rare in that we have adopted some what we think very sophisticated technical the investment management the methodology. Looking to be invested, but to be watching carefully to get out if it looks like things are turning before there's a lot of losses. Obviously, it's never guaranteed. But we think our track record has been really, really good, particularly this year. And a lot of the methodology we use is very long term, very, very effective track records. So another thing that we tend to do, and the clients that work well with us, is focus on long-term objectives and results, not just short-term investment noise, but getting back to stay richer, live freer. What's the purpose of this money? Is it for retirement? Is it to build a legacy for your family? Is it to make a big impact philanthropically? Whatever it is, as Stephen Covey said, begin with the end in mind. What's the objective? And then manage the money and the wealth for what the long-term objective is. Not just look up, down like that. Mm-hmm. You want to look down up here, and that's where we want to go. And we realize there's going to be some bumps along the way, but so long as we read the map and stay on the path, we should get there. That's kind of the objective. So and the last thing is that the clients we work well with tend to invest in the best advisors like us they can find for investments and tax and asset protection and so forth. And they appreciate that the best advice is not cheap. One of the things on transparency, the worst advice is often more expensive. You just don't know it, right? So if you have an advisor that is charging transparently, this is what our fee is, here it is on the statement, you see it every time, it's honest. But if you're investing, in good advisors, the payoff can be pretty dramatic. In fact, there was a study from Vanguard, actually a while ago, Vanguard, low-cost leader, Walmart in the investment world, really, index funds, that showed that by paying an investment advisory fee, I think it was 1%, something like that, maybe a little bit more, the actual wealth for the client was almost 3 times as much, according to this graph on the bottom of the slide that Megan had up there for you. So that's pretty dramatic, I think. Any expanded comments on that?
Yeah, no, absolutely. I mean, like I said, the right advice can be, it can seem to be more costly, but the wrong advice, I feel, can cost you a lot more if you're in the wrong hands and they're not, you're looking out for your best interest for one, but also may have you in some expensive products that don't appear on the surface to kind of show you exactly what you're paying for them.
Yeah, and another thing we do that we'd like to maybe talk about in this segment is a recent study by a big outfit called Smart Asset in New York City, and showing the net worth with and without a financial advisor. And the model demonstrates that the lifetime benefit of an advisor after paying escalates as the starting net worth rises. This example for a 45-year-old starting a client planner relationship at various timelines. And you can see that last bar on the right, again, 3 times as much wealth, maybe a little bit more, after paying for the advice. And so what are, the domains that drive that? Is it just investment performance?
No, it's not. I would say a big part is tax, right? Doing, tax, making sure keeping tax as a big consideration can really help you build your wealth faster, right? If we can legally and within, framework, avoid paying taxes that you don't need to pay, that's going to help you build your wealth faster.
And that's a really good example. We had a recent case, complicated case, just going to sketch some highlights, where there was a lot of money they inherited, which was in a trust. The trust had to pay its own taxes. It was a taxable, irrevocable trust, which is often what happens after the person that puts the money in a trust, the grantor, dies. And a lot of money in there, right? And this is being managed mostly by a broker, as I recall. And the broker, again, not fiduciary advisor, commission-based, not tax savvy, their objective apparently was making as much money for themselves as they could on commissions, and also, trading very frequently, to generate more commissions and maybe more sizzle in the portfolio. So even if the portfolio had done well investment-wise, turns out it underperformed the S&P 500, there was still all this tax drag. Every time they're trading, it's producing a taxable income where they're buying bonds, that pay taxable interest. And the tax drag was like hundreds and hundreds of thousands of dollars a year, right? Completely avoidable, and why, did they have this horrible outcome? And so one of the things that we really bring to the table is understanding trust taxation. Trusts, by the way, are taxed at the very highest rate, almost from zero. It takes a couple married filing jointly. You have to get to $750,000 in income before you get to the highest tax bracket. Trust is at $16,000, almost zero. The whole thing taxed at the highest rate. Do you want to pay tax in a trust? No, of course not.
Nope.
But there was no coordination between the lawyer that wrote it and the CPA that just took the numbers. Okay, you got to pay your taxes. No tax input to the client or to the broker, and the broker just trading, trying to, I guess, create wealth and commissions for themselves. It was just a mess. So some of the things that we did to improve that is, okay, listen, trustee, let's stop trading so much, and let's find ways to not create taxable income. You want to pull money out of the trust. You know what really rich families do? They put the money in, they grow it, they don't trade it and create taxable events, and then they borrow against the portfolio. Pull the money out, you know what? That's a not taxable transaction. Allowing the wealth to build maybe $500,000 a year more. And we also explored ways, gee whiz, can we get this asset out of the high tax trust, maybe into something, maybe into a lower tax environment, and in conference with the tax attorney on our team, looks like there's a couple opportunities to do that.
Sure.
One of my favorite ones is let's get it out and give it to one of the other family members who's pretty up there in age. And when that family member passes, they'll get a step up in basis, and all the capital gains tax on millions of dollars of stuff will be forgiven. That's a grand slam, I think.
That's a good one.
So having a financial advisor that coordinates tax control and asset protection, and estate planning, and on beneficiary control, and real estate and businesses, and has the expertise and the vision and the caring. So let's move on now to what's kind of happening in the world. This is a piece from Barron's over the last weekend, which I've retitled, "Is the Stock Market Bubble Finally Here?" So welcome back to the second segment, of course. I'm Dr. Jeff Camarda.
I'm Lou.
I'm Anna.
Of course. And today we're talking about one of the hottest and potentially most dangerous areas in the market right now, and that's semiconductor or technology stocks and the AI boom. This Barron's article titled "5 Signs That the Semiconductor Rally is Getting Silly" asks a really important question, and that's, are we witnessing the early stages of another tech bubble? And honestly, whether you're bullish or bearish on AI long term, I'm pretty bullish on the technology. The economics are yet to be seen. Investors really need to pay attention to what's happening underneath the excitement. So let's start out with you, Lou. What's your surmise from the article?
Yeah, I mean, the numbers in this article are kind of staggering.
Yeah, the semiconductor index apparently surged nearly 54% in just the last 25 trading days.
Which is extraordinary. I mean, the article points out that this was the best 25-day rally for the Philadelphia Semiconductor Index, the SOX, since the peak of the dot-com bubble in 2000. And that alone should get your attention, because historically, when markets move that far, that fast, it usually signals either a transformational opportunity, let's hope so, or speculative mania, or both maybe at the same time. So AI really is driving everything, isn't it, Anna?
Yeah, and the engine behind the semiconductor growth obviously is artificial intelligence.
Exactly. AI demand is creating an arms race for computing power, and every major company wants AI, including ours, wants AI infrastructure. In fact, we're building a lot of our own. Governments want AI leadership, cloud providers are spending very aggressively, and investors are really extrapolating massive future growth, kind of expecting, extending the trend, extrapolating massive future growth into current stock prices far beyond the current valuations. Now, importantly, the article is not saying AI itself is fake. It's here. We use it every day. That's a critical distinction. The internet was real during the dot-com bubble, even though lots of people lost their shirts. And many internet stocks still obviously became wildly overpriced. Some just broke even actually last week after 25 years or something. And that's where we may be entering dangerous territory with technology stocks.
Yeah, the article highlights several warning signs, I think.
So let's walk through them because I think they really matter. First, the pace of gains. Historically, the SOX index only experienced rallies this powerful during major speculative, i.e. bubble-like periods. The article notes that after the massive March 2000 rally, stocks eventually collapsed about 80% during the following bear market. Now, that doesn't mean history repeats exactly, but remember, it rhymes, and it reminds us that momentum can really reverse violently.
Yeah, and another warning sign the article talked about was overbought conditions.
Exactly. The Van Eck Semiconductor ETF ticker SMH, by the way, showed an RSI, a relative strength index, above 70 for 17 consecutive trading sessions, which is kind of sky high. For listeners not familiar with RSI, probably most of you, it's a momentum indicator, generally speaking. Above 70 suggests the market may be heavily overbought. Below 30 suggests it may be oversold. Now, overbought markets can absolutely continue rising. The market can stay irrational a lot longer than you can stay solvent, as I say. But historically, sustained RSI extremes often precede corrections or periods of consolidation. So, Lou, what is fascinating to you?
So, to me, what fascinates me is how quickly investors, psychology changes during these phases.
And that really is the key, right? Markets move from skepticism to optimism to excitement, to full-blown drooling, crazy, to eventually what we call narrative dominance. And we may be experiencing that stage now because suddenly every company with exposure to AI chips is being treated as if future profits are guaranteed. And that's really dangerous thinking. During speculative periods, investors stop asking, what's this company worth? And start asking, how high can it go? How much higher can it go, I should say. And that's when discipline really disappears. Hey, Anna?
Yep. And at the same time that we're talking about this, some analysts feel like we're really in a genuine AI revolution.
And they may be right. The article quotes from Dan Ives from Wedbush, who believes enterprise and government AI spending could reach $3 trillion over the next 3 years. That's enormous. And unlike some past speculative booms, AI is already delivering a real-world productivity like you wouldn't believe. Just like tasks that used to take me an hour or 90 minutes, I'm done in 7 minutes, literally, and often with higher quality. So we're seeing applications in healthcare, finance, logistics, some tax AI, and financial planning routines that we're writing internally. Now it's our own Camarda AI, software development, cybersecurity, manufacturing, customer service. So the long-term secular trend is absolutely real in my view. The challenge that markets often overshoot even when the underlying technology is legitimate. I'll tell you guys an example from a commencement speech I remember that Warren Buffett gave a long time ago, saying, just because the technology is transformative and he used the airline industry doesn't mean you're going to make money out of stock. A lot of people lost their shirts on airline companies, throughout the 20th century. So lessons, how about some lessons from market history, Lou?
This feels similar to previous technological revolutions.
It surely does. Railroads, electricity, telecommunications, the internet, every transformative technology created both incredible wealth creation and speculative excess that really cost investors maybe their life savings. The winners eventually changed the world, but many investors still lost fortunes because they paid irrational prices at euphoric peaks. That distinction is critical. A great technology does not automatically equal a great investment at any price. So what should smart investors watch, you think, guys?
Yeah, I mean, the first one is valuation discipline, right? So even as revolutionary companies can become, overpriced, right? You still want to look at fundamentals when making investment decisions.
Right.
Second is concentration risk. Many portfolios, are becoming dangerously concentrated in a handful of mega cap AI names.
Like S&P 500, like half the valuation, 7 stocks, sorry.
No, exactly. And then expectations, right? The higher expectations rise, the harder it becomes for companies to keep exceeding them. And volatility is another concern. These rallies feel great on the way up, but high momentum sectors can reverse with shocking speed. And then you have to distinguish, between AI as a technology trend and then AI related stocks as investments. They're not always the same thing.
That's really a big point, And Lou, and thank you by the way for all that information. So Lou, why don't you continue? One thing that I know you appreciate is that it doesn't really scream crash imminent. So how do you feel about that?
Exactly. I mean, it's more nuanced than that. The article basically says, yes, the rally looks extreme. Yes, historical comparison are flashing caution signs, but also yes, AI demand appears very real. That combination creates an environment where disciplined investors must balance opportunity risk with management, and frankly, that's always where real wealth is built.
That's where the rubber hits the road, isn't it?
Yeah.
Not in blind optimism, not in blind fear, but balance, rational calculations, which most investors really never learn how to do. But in disciplined thinking, well, everybody else becomes emotional. And that really is the big danger. So in closing, any parting thoughts, Anna?
No, I just think we're seeing a lot of headlines about AI and semiconductors and those stocks right now. So I think it's important to relay this to clients.
Especially as high as the market is going, just a high, crazy valuations, highest valuation in history, according to the Wall Street Journal, except for the .com bust of 25 years ago, and it looks like we're right back up there.
Especially for anyone feeling FOMO or for fear of missing out around AI stocks right now.
Absolutely. I mean, it's if you don't be afraid of missing out. The money is that you already did miss out, so wait, till the next downturn, I would think, right? So absolutely remember, some of the greatest investing mistakes in history happen when investors believe this time it's different, and sometimes it is different, but human psychology really changes. And anyway, thanks for joining us on the Winning the Wealth Game with Camarda and this new current event segment. Hopefully you guys like the new format. And if you like today's episode, obviously share it with somebody trying to make sense of the AI boom and maybe getting some intel on what real good advice can look like. Anyway, thank you so much. From Camarda Wealth, I'm Dr. Jeff Camarda, of course, joined by my super CFPs, Lou and Anna. Until next time, thanks for watching.